Silver and Gold Turbulence, the hidden truth behind COMEX margin hikes. Silver and Gold Turbulence, the hidden truth behind COMEX margin hikes. Every time prices surge, margins rise, liquidity vanishes, and panic replaces logic. Headlines call it suppression, commentators call it manipulation, most investors call it the end. But what if margin hikes are not the cause, only the signal? What if the real danger is not falling prices, but misunderstanding who controls the market when volatility explodes? Because when margins rise, someone is being protected first, and it is rarely who the public assumes. Behind these quiet rule changes lies a structure built for survival, not fairness. A structure that decides who stays solvent and who is forced out silently. If this moment is misread, every major move that follows will be misread as well. And by the time certainty returns, positioning will already be over. Stay with us, because what happens next is never explained in the headlines. Welcome to Hidden Currency. If someone has lived through more than one market cycle, if they are building something that must survive volatility, not just profit from it, they are in the right place. Before going any further, consider subscribing, not as a habit, but as one careful investor speaking to another, someone who understands that experience takes time. Tell us, from where in the world are you watching today? Markets may be global, but understanding them always begins locally. Now, let us begin. Silver and gold markets rarely move quietly. When they move with force, attention follows. Prices surge, screens flash green, and confidence spreads quickly. But just as often, the excitement is interrupted. Margin requirements rise. Positions are cut. Prices pull back sharply. Confusion replaces clarity. For many observers, the sequence feels familiar. They have seen it before. Each time the same questions surface. Is this price suppression? Is the market being controlled? Or is this the signal that the rally has gone too far? Most discussions stop there. They focus on emotion rather than structure. Fear replaces analysis. Anger replaces understanding. Yet the most important information is hidden not in the price itself, but in the response of the system around it. The futures market for silver and gold is not designed to express long-term value. It is designed to manage short-term risk. This distinction is often overlooked, but it sits at the center of every margin increase. When volatility expands, the system responds. Not because of where prices are going, but because of how fast they are moving. Margin is not a tool to control prices. It is a tool to control failure. Futures contracts allow participants to control large positions with relatively small amounts of capital. This leverage is attractive in calm markets. It amplifies gains when prices move gradually, but leverage becomes dangerous when price movement accelerates. In those moments, small price changes can trigger large losses. If those losses cannot be covered, the risk spreads beyond the trader to the entire system. This is where margin requirements enter the picture. They exist to ensure that participants can survive adverse moves. When volatility rises sharply, existing margins may no longer be sufficient. The system adjusts. Participation becomes more expensive, not to punish traders, but to protect settlement. What most people miss is timing. Margin increases rarely appear at the start of a move. They appear after volatility has already built up. By the time an exchange announces higher margins, the risk has already been present for days or weeks. The announcement is not the cause of instability. It is the acknowledgement of it. In recent periods, silver and gold experienced rapid intraday swings. These were not slow, deliberate revaluations. They were sudden movements occurring during thin liquidity. Holiday sessions, overnight trading hours, and low-volume windows magnified each trade. In these conditions, prices can move far with limited capital. Thin liquidity is where leverage breaks first. When markets are deep and active, large positions can be absorbed gradually. When participation is light, the same positions create outsized impact. Risk models detect this shift quickly. Volatility expands beyond normal ranges. Margin requirements adjust automatically. This response is mechanical, not emotional. Algorithms measure price movement, not opinions. They react to deviation, not narratives. A sharp upward move triggers the same response as a sharp downward move. Direction is irrelevant. Speed is everything. The exchange does not ask whether prices should rise or fall. It asks whether trades can still settle if prices reverse. If the answer becomes uncertain, margins rise. This reality clashes with popular perception. Many believe margin hikes are designed to stop rallies, but if that were true, prices would not recover after these events. History shows otherwise. Time and again, margin-driven corrections are followed by stabilization. In some cases, prices move higher once leverage is reduced. This pattern reveals something important. It shows that not all buyers are equal. Some participants enter the market with borrowed time and borrowed capital. Others enter with balance sheets built to withstand volatility. When margins rise, these differences are exposed. Those relying on high leverage are forced to act. Those operating with structural capital remain. The price drop that follows is often misinterpreted. It is seen as demand disappearing. In reality, it is leverage leaving. Understanding this distinction changes everything. It reframes margin, increases from acts of control into signals of stress. They reveal where risk has concentrated and how fragile the recent move may have been. For business leaders and investors, this matters deeply. Markets do not fail when prices fall. They fail when obligations cannot be met. The true function of margin is not to manage optimism or pessimism, but to preserve trust in settlement. This is why margin increases often feel sudden and harsh. They are not designed for comfort. They are designed for survival. Because long before the public reacts, the system has already begun to defend itself. Long before the public notices a margin increase, pressure has already begun to build beneath the surface. The exchange is rarely the first to act. The earliest response comes from institutions that never appear in headlines, yet quietly determine who survives periods of extreme volatility. These institutions are the intermediaries. They sit between individual traders and the central clearing system. Their role is not to predict price direction, but to absorb risk if others fail. When markets are calm, this role goes unnoticed. When volatility explodes, it becomes decisive. Every trade in the futures market passes through a clearing firm. These firms guarantee performance. If a trader cannot meet a loss, the clearing firm must cover it. This obligation shapes everything they do. Survival depends on controlling exposure before losses become unmanageable. Because of this, clearing firms do not wait for exchanges to raise margins. They act first. They monitor client positions in real time. Sophisticated risk systems track leverage, concentration, and exposure across portfolios. When volatility accelerates, these systems begin to flash warnings, not days later, not after headlines, immediately. At that moment, the clearing firm faces a choice. Either demand more capital from clients or reduce risk forcefully. There is no third option. Waiting increases danger. Hesitation compounds losses. This is where internal margin calls begin. These margin increases are invisible to the broader market. They do not appear in news alerts. They are communicated privately to clients. Often, they exceed what the exchange will later require. The goal is simple: protect the firm before risk becomes systemic. For the trader receiving such a call, the experience feels abrupt. One moment the position is open, the next, additional capital is required. The trader may not know why. They may not know that volatility models have shifted. They only know that the cost of staying in the trade has risen suddenly. Many cannot respond. High leverage participants are the most vulnerable. Their positions were built on narrow margins. Even a small increase in requirements can make this position unsustainable. They are forced to reduce exposure. Some sell partially, others exit completely. This selling begins quietly before any public announcement. This is the first wave. By the time the exchange announces its own margin increase, much of the damage has already occurred. The visible sell-off that follows is often mistaken for the beginning of panic. In reality, it is the continuation of a process already underway. The sequence explains why markets sometimes appear to fall on news that seems insufficient to justify the move. Observers see the announcement and assume causation. They miss the earlier hidden phase where risk was already being reduced. The exchange's role comes later. Its margin increases apply broadly and uniformly. They are public, documented, and widely discussed. But they are also slower by design. The exchange responds to confirmed volatility data, not early warnings. This layered response creates confusion. It makes market reactions appear exaggerated. In truth, multiple defenses are activating at different levels, each with its own timing and thresholds. Understanding this structure reveals why price moves following margin hikes often feel violent. Liquidity is already thin. Leverage has already begun to unwind. Automated systems amplify the effect as technical levels are breached. Stop orders trigger. Algorithms execute without discretion. The result is not chaos. It is mechanical acceleration. Another misconception emerges here. Many believe large institutions benefit unfairly from margin increases, while smaller participants are forced out. This view misunderstands capital structure. Commercial participants enter these markets with different objectives and resources. A mining company hedging production is not trading for short-term profit. It is managing operational risk. Its positions are backed by physical output and corporate balance sheets. When margins rise, these participants adjust without distress. They were never dependent on maximum leverage. Speculative traders often are. The rules apply equally. The impact does not. This difference fuels suspicion. From the outside, it looks coordinated. From the inside, it is mathematical. Capitalized participants remain. Fragile positions disappear. Once the forced selling ends, pressure often fades quickly. There is no ongoing supply of sellers. The event is finite. Markets stabilize not because fear vanished, but because leverage has been cleared. For serious investors and business leaders, this insight is critical. Margin-driven sell-offs do not reveal the death of a trend. They reveal the removal of excess risk. They expose how the move was built. Those who mistake this process for manipulation often react incorrectly. They abandon positions. At the moment, structural strength is being revealed. They confuse volatility with weakness. The futures market is not designed to reward belief. It rewards preparation. In the next part, the focus shifts to the models and thresholds that govern these decisions, the systems that decide when volatility becomes unacceptable, and why these systems care far more about speed than direction. Because once volatility crosses certain limits, human opinion no longer matters. At a certain point in every volatile market, human judgment steps aside. Decisions are no longer debated or delayed. They are executed automatically. In silver and gold futures, that point is reached when volatility moves beyond what the system defines as tolerable. This is where algorithms take control. Contrary to popular belief, exchanges do not rely on committees reacting to headlines or market sentiment. They rely on models. These models measure how far and how fast prices are moving compared to historical norms. They do not care whether prices are rising or falling. Direction carries no weight. Only deviation matters. When prices accelerate too quickly, the system responds. Volatility is measured over defined time windows. Intraday ranges, daily moves, and short-term standard deviations are continuously recalculated. When these metrics exceed preset thresholds, risk flags are triggered. Margin requirements adjust accordingly. This process is automatic. There's no debate about whether silver deserves to trade higher. Risk has outpaced reward. Longer-term participants experience something else entirely. For them, the margin increase is not a threat. It is a signal. It indicates that the market has entered a new volatility regime. Participation requires stronger balance sheets and longer time horizons. This transition is rarely smooth. As algorithms enforce higher margins, liquidity contracts. Fewer participants remain active. Each trade carries more impact. Price movements become sharper, not because demand has vanished, but because the market is thinner. This is where confusion peaks. Observers see violent price swings and assume instability. In reality, the system is stabilizing itself by reducing participation. Volatility spikes before it settles. This is not a flaw, it is the mechanism working. Another critical detail is often overlooked. Margin models do not reset immediately. Once volatility rises, elevated requirements tend to persist. The system does not lower defenses until movement returns to normal ranges for sustained periods. This means that after a margin hike, the market enters a different phase. It is no longer driven by speculative excess. It is driven by participants willing and able to operate under tighter conditions. This is why prices often find support after margin-driven declines. The forced selling ends. Remaining participants are stronger. The market recalibrates around a new equilibrium. Understanding this helps explain why margin events often mark turning points rather than endpoints. But there is a deeper implication. Algorithmic control removes discretion. When thresholds are breached, actions occur regardless of context. This can produce outcomes that appear irrational to human observers. Prices may fall despite strong fundamentals. Rallies may stall despite bullish news. The system does not evaluate fairness. It evaluates survivability. For business leaders watching from outside, this dynamic offers a lesson beyond commodities. Systems built to manage risk will always prioritize continuity over opportunity. They will sacrifice participants to preserve structure. Those who do not understand this often find themselves surprised at the worst moments. They assume markets respond to logic or valuation. In leveraged environments, markets respond to constraint. Margin increases are not opinions expressed by institutions. They are constraints imposed by mathematics. This realization reframes volatility itself. Extreme moves do not signal loss of control. They signal that control has tightened. In the final part, attention turns to what remains after leverage is removed. What margin events reveal about real demand, structural strength, and who ultimately determines long-term direction in silver and gold. Because once the system has defended itself, only the strongest participants are left to decide what comes next. When margin increases finish their work, the market looks different. The noise fades. The frantic activity slows. What remains is quieter, but far more important. This is the phase most observers fail to study, yet it reveals the true condition of silver and gold markets. By this stage, leveraged participants have largely exited. Their selling was not strategic. It was compulsory. Once their positions were closed, that pressure ended. There is no ongoing supply of forced sellers. The market is no longer reacting to margin calls. It is reacting to fundamentals again. This transition is subtle but decisive. Prices may still fluctuate, but the character of movement changes. Volatility compresses. Liquidity stabilizes. The market begins to reflect the intentions of participants who are not dependent on borrowed capital. These participants operate on longer timelines and different motivations. This is where real demand becomes visible. In precious metals, real demand does not announce itself loudly. It does not chase momentum. It accumulates during weakness and pauses during excess. When leverage-driven selling clears the market, this demand is no longer masked by speculative flow. Commercial users continue to operate. Manufacturers still require metal for production. Refiners still manage inventory. Long-term investors still seek protection against monetary risk. These forces do not disappear during margin events. They wait. This is why margin-driven declines often fail to extend indefinitely. Once forced liquidation ends, price discovery resumes on a different basis. The market is no longer answering the question of who can survive volatility. It is answering the question of who actually needs the asset. This distinction separates short-term disruption from long-term trend. For silver and gold, this matters because their role extends beyond speculation. They function as industrial inputs, monetary hedges, and strategic reserves. These roles are not affected by margin policy. They are affected by economic conditions, currency stability, and supply constraints. Margin increases cannot change those realities. What margin events do is expose how much of the recent price movement was built on fragile structure. When a rally collapses completely after leverage is removed, it suggests the move lacked depth. When prices stabilize and recover, it suggests underlying strength. This is the diagnostic value of volatility. Experienced market participants understand this. They do not view margin hikes as verdicts. They view them as stress tests. They observe who exits, who remains, and how the market behaves afterward. This perspective is especially relevant for business leaders and entrepreneurs. Financial systems operate on similar principles. Growth, fueled entirely by leverage, is vulnerable. Growth, supported by cash flow and resilience, survives tightening conditions. Markets teach this lesson repeatedly. Another overlooked element is time. Margin-driven events are compressed. They occur quickly. Their effects are front-loaded. Once completed, they leave behind a clearer environment. This clarity is uncomfortable for those who relied on momentum, but valuable for those focused on structure. At this stage, headlines often lose interest. Volatility no longer generates clicks. Public attention moves on. Yet this is precisely when strategic positioning becomes possible. Those who misinterpreted the margin event as failure are absent. Those who understood it as rebalancing remain. This is not a guarantee of immediate upside. Markets can consolidate, they can drift, they can retest levels. But the nature of risk has changed. The probability of forced, disorderly liquidation has decreased. The system has absorbed the shock. For silver and gold, this often precedes a new phase. Not always dramatic, sometimes gradual, but grounded. The broader lesson extends beyond metals. Modern markets are governed by structure before sentiment. Risk controls act before narratives form. Those who focus only on price movements miss the signals embedded in how the system responds. Margin increases are among the clearest of those signals. They indicate that volatility reached a level the system could not ignore. They reveal where leverage concentrated, and they show how quickly participation can be reshaped when constraints tighten. For decision makers, this understanding is not optional, it is foundational. Markets will continue to experience turbulence. Volatility is not an anomaly, it is a feature of leveraged systems. The question is not whether margin hikes will occur again, they will. The question is whether observers will continue to misread them. Those who do will react late, exit early, and misunderstand outcomes. Those who do not will recognize margin events for what they are. Moments when structure asserts itself. Moments when weak positions are removed. Moments that clarify rather than conceal the true state of the market. In the end, silver and gold do not move because of margin policy. They move because of supply, demand, and trust in the monetary system. Margin increases simply determine who is allowed to participate during periods of stress. And once that process is complete, the market speaks more honestly than it did before.